even gonna finish this, that's great. I wasn't sure we were gonna finish all these tonight, but we are, that's good. Example 8, expected cash flows. Oh wait, sorry, litigation claims. So, some contingent liabilities are from litigation. That was my first example I used. A couple things associated with litigation. The majority of medium and large size firms annually report loss contingencies due to litigation. Why? Because they get sued all the time, right? Especially in the United States, where lots of litigation going on in the United States. But it is relatively rare for firms to accrue losses from ongoing litigation. In other words, it's relatively rare for litigation that has not yet been resolved to show up as a liability on a balance sheet. Any idea why?
They try to resolve it the same year.
Say that again?
They try to resolve it the same year and have to show it on the balance sheet.
That's true. Why? Why would that be an important thing to do?
Image of the company.
Okay, so close. I mean, they're still going to have to show that they had this loss, and that may be bad for their image. Killed someone, whatever they did, bad. And they're going to have to show that they had a loss for that, and that maybe they paid out cash for it. Why specifically for litigation would it be bad to put on your balance sheet for ongoing litigation that you think you're going to have to pay this money out?
It's hard to say how much you're gonna pay, right? They still have a chance to win.
Okay, you still have a chance to win. And what's going to happen in the courtroom when your financial statements are...
Saying you're guilty.
yeah.
Saying you're guilty.
Yeah, so the other lawyer is going to take the financial statements and show to the jury, look, they admit that they are liable for this, and this is how much they think they're liable for, and that's exactly what would happen every single time. And so for ongoing litigation, or they're going to take it to the judge, or they're going to take it somewhere, and basically it's not going to be true, but it's going to look like they're admitting guilt, is what it does. And so for ongoing litigation, rarely are you going to accrue it. Either you're going to do all you can to make it so you consider it only reasonably possible, or you're going to settle before the end of your fiscal period. So that it's resolved before the end there. So many settlements are done quickly to avoid that potential problem. So the most common disclosure is a note to the financial statements. So calling it reasonably possible is much more common than actually accruing something specific for litigation. Our last example of a liability is an example using expected cash flow. This is one way of estimating something. We used this previously for our asset retirement obligation example, if you remember that. We used expected cash flow. This is commonly used for litigation and these types of things where it's contingent on something happening in the future. So here's our example. Payne Corporation has a class action lawsuit pending against the firm. The lawsuit claims that the executives misled investors with regard to a recent acquisition. This type of lawsuit is almost always settled by the defendant. At the end of 2010, the expected settlement amounts are as follows. So they think there's a 10% probability they'll pay out $200,000, 50% probability it'll be $1 million, 30% $2 million, and 10% $10 million. Payne Corporation expects to settle and pay at the end of 2011, use an interest rate of 8%, and record the necessary journal entry. So the first thing we need to do is come up with what we think the estimate's going to be. And again, we're going to use it weighted by the probabilities, and so we're going to multiply each one of these out, just like we did in that other example. It's going to give us 20,000. And again, this is only one way of estimating this. There are other ways of estimating. We talked about that last time. We won't get into it again. And so we estimate that we're going to have to pay out $2.12 million. Are we actually going to have to pay out that amount? Probably not. But this is our best estimate using this particular method, which is a very common method for estimating something. So we think it's going to be about $2.12 million that we have to pay out. And did it say that it's probable? They expect to settle and pay. We're going to call that probable in this example. And they expect to pay it at the end of 2011. So when we record this journal entry on December 31st, 2010, we're going to accrue the liability because we can estimate the amount we just did, and it's probable that we're going to have to pay out. So we're going to go ahead and accrue this liability, this contingent liability, and we're going to go ahead and put this liability on our balance sheet. Should we put it on our balance sheet at $2.12 million? No, because the cash flow is going to happen in a year. So we need to discount it one period to today And so just like before, we're gonna take the present value, and it gives us an interest rate of 8%, or discount rate of 8%. It's gonna be one period, and that is going to give us 1.962972. 1,962,972. That's just the present value of this brought back one period at 8%. We're gonna record the journal entry, and that is going to be for a loss of 1,962,972, and a liability associated with litigation of 1,962,972. Alright, so this is another example of when we don't use the maturity amount, instead we use the present value of future cash flows. Anytime we have to talk about a longer term liability, in this case it's a year, we would go ahead and do the present value of those numbers. Alright, assume that they end up paying $10 million at the end of 2011, record the payment. Alright, I think I'm gonna go ahead and do it the right way. Sometimes I do the lazy way. I'm gonna do it the right way this time. So, from this period until one period later, this thing is going to grow because time has passed. And so we're gonna go ahead and record an increase to this liability. We're gonna credit the liability for the litigation. And we're gonna increase it up to the 2.12 million. To be honest, I don't know what the difference is. That's the one there. So 157,028. And we're going to debit, what do we want to call this? It's not interest, probably going to call this accretion again. Not, doesn't look right. What? Yeah, I don't know, whatever. Accretion expense.
No C.
There's no C?
Before the T.
Yeah, that one.
ACC. Yeah, get rid of that. There's no C there. I don't know, whatever. Accretion expense, 157,028. You could call that interest expense. Kind of a fine line there. Yeah.
How do you get 157?
That is the difference between the 2.12 million and this number right here. It's the amount that it would grow with for 1 year. And then when we finally pay out the 10 million, we're going to credit cash of 10 million. Credit cash of 10 million. We got two things above this. We're going to get rid of the liability, which after this thing right here is now 2.12 million. And we're going to have a loss for the difference, which is going to be 7,880. What if it ended up being 1 million we have to pay out? Then we have a gain of 1,120,000. What if it was any other number? Then whatever it would be credit to cash of that, the difference between a gain or loss, the difference. So the lazy way that I sometimes do this is I ignore this expense and I just lump this into the loss. Do one journal entry. Any questions on that? So we've done a lot of different things tonight. None of them are hard. Do you agree with that? None of this is really hard. It's just a bunch of little things. That does make it hard. You guys do that. A couple last things, and these are very, very small items. Subsequent events. Events occurring between the year-end date and the report date can affect the appearance of the disclosures on the financial statements. We have two different potential things that could could be true. The first one is what we call a clarifying event that helps determine how contingencies are reported. And the second one is if the loss contingency occurs after the year end, and in that case you disclose. And so we draw a little picture. This is our fiscal period. Let's say that this is December 31st, our fiscal year end. And then we have a period of time, then we have our report date. So, fiscal year end, December 31st, and then we finally send out our financial statements in March sometime, or February sometime. And so there's this period of time in between. And the question is, let's say that whatever the bad thing is we did happens on this date right here. We hurt someone. Killed somebody. Go back to that. We killed somebody on this date right here. On December 31st, we think we're going to have to pay out $1 million. By the time we get to the report date, we have some new information, and we know and we're pretty sure it's going to be $2 million. The question is, what goes on the balance sheet? Is it the $1 million we thought on December 31st, or is the $2 million that we're more sure of later on, prior to actually issuing the financial statements? And the answer is, clarifying events help determine how contingencies are reported. So new information prior to the report date for things that existed as of December 31st can update that information. So if we thought it was 1 million here, and we think it's 2 million here, on the balance sheet you're going to see 2 million, not 1 million. So we can update contingent liabilities with new information.
Only if it's material or
Yeah, probably. If it's immaterial, then who cares? Doesn't matter. So yeah, probably only if it's material, but we actually do anything. You're right. So, but it has to have existed. We have to have done the bad thing prior to the fiscal year end. The other one, if the cause of loss contingency occurs after the year end, so instead of killing someone here, we killed someone here. It didn't exist as of December 31st. It's not going to be a liability on that balance sheet. But we do have the responsibility to disclose the information. So in the notes, we'll disclose, we'll basically say, after the fiscal year end, this bad thing happened, we think we're going to have to pay out some money. So, but it does not go on the balance sheet because it did not exist as of December 31st. Does that make sense? Do you see the difference between the two? So things that existed as of December 31st, you can use new information to update the amount, but if they didn't exist December 31st, it's never going to go on the balance sheet. You do disclose it in the notes. Those are those two things. Unasserted claims and assessments. So let's say that we kill someone but no one sued us, but we're guiltily standing by the side and saying, we're probably going to pay something out for this, but no one sued us yet. That's an unasserted claim. And so we have a two-step process. Number one, is a claim or assessment probable, using the same definition of probable? If yes, go to step number 2. If no, you don't have to disclose it. Step number 2, you evaluate the likelihood and whether it can be estimated the same way as any other contingent liability. Or in other words, if it's probable, you do the same thing as a contingent liability. If it's not probable, then you don't have to even disclose it if it's unasserted at this point. So it basically gets rid, go back to this picture, of the reasonably possible. If it's probable, then do these things. If it's anything other than probable, then just don't disclose anything. Don't do anything. That's only if it's unasserted claims and assessments. Last idea, gain contingencies, and we're going to get out a couple minutes early. Yay. I think, did we go late last time? Yeah, I think we might have at least a couple minutes. Gain contingencies. Everything we've talked about with regard to the contingencies are liabilities and losses. Gain contingencies don't exist. As a general rule, we never record gain contingencies, but we can disclose them. So, for example, if something bad, if someone did something bad to us, and we sued them, and it's likely we're going to have to pay out, we don't record a gain in an asset until it's actually realized. So, gain contingencies we're much more conservative with. We wait to record those until they're realized. Losses we're going to record much sooner. And why? Counting conservatism is the difference between the two. Current liabilities. We're done. Any questions? Alright. So what is this gonna look like on the exam? Because you're not gonna have a quiz over anything on this chapter, right? No quiz on this chapter. What does it look like on the exam? There's gonna be multiple problems that are similar to the, how many examples did we do? We did 1, 2, 3, 4, 5, 6, 7, 8 different problems. There's going to be problems on the exam that are similar to at least 2 or 3 of those. And you're going to work out similar problems. There's going to be multiple choice questions asking about some of the ideas in here. But there's no really big problems. They're all about the size of one of these that we've looked at. And in general, they're not that hard. You'll do just fine. All right. Enjoy your spring break. Don't think about accounting the whole time.